The Fed is getting its way all over the place. If you were to substitute more recent shelter data, specifically rents, for the extraordinarily lagged data that is going into the Fed's calculations, they are very much going to continue to get their way in January, February, and March. We're looking at the next CPI report, most likely with a 6 handle, and that is most likely going to continue to fall from there. The question is, how fast will it continue to fall? And I know that sounds crazy. We've been like, oh, it's so stubbornly high, forget about it. You just got U.S. retail sales in November down 0.6. That was supposed to be down 0.1. The consumer has gotten the message. They have stopped spending in a lot of categories on a dime. The housing market is frozen. There is nothing going on there. Don't tell me that the Fed isn't making progress on inflation. After talking to mortgage people, realtors, forget it. It's over. And housing has a huge multiplier effect. It could be as high as 18% of the economy. What we saw in the inflation data Tuesday, CPI, medical costs are falling, airline ticket prices are falling, gasoline is down month after month after month, even electricity costs have fallen. So the Fed is getting their way, but they have to keep talking this way, regardless of what the 10-year is doing, which is laughing in their faces. They have to keep talking this way because the worst risk is that we take a pause, and then because people let down their guard, financial conditions start to ease a little bit, and then all of a sudden they have to come back with another 50, another 75.
Right?
We don't want that.
They already have.
We don't want
Since
that.
the last hike, the financial conditions have been easing. Right, and that's been one of the issues. Everything that you said, Josh, of course, is correct in terms of the direction of inflation, yet they're not satisfied. Why? Because they're willing, it sounds like, and it certainly seems like, they're willing to have a recession. They essentially want to put the economy in a chokehold and hope that it taps out without being carried out on a stretcher. That's what Powell's hope is. Why? Because he needs the economy to tap out.
He could say whatever he wants. He could say whatever he wants. He cannot continue to raise with the 2-year, 5-year, and 10-year falling at the pace they are. The dollar has peaked. Rates have peaked. The Fed can say whatever they want, and arguably they should continue to deliver this message. But the concern in the market, and rightfully so, is now shifting toward recession and away from inflation. And everybody knows it. And all of the data is screaming that message. And I'm going to tell you, a lot of the economy already is in recession, in addition to what I just talked about with housing. And I think the rolling recession call, which I think is Citigroup, is going to be the right one because we're already living through it. It's not a prediction. It's actually happening. A rolling recession is interesting. It's not as coordinated as you would like it to be, like in COVID, where we actually could pinpoint the start of the recession to a specific day in March. This is trickier, but a rolling recession is what is currently occurring. It's undeniable in certain sectors, and if it hasn't gotten to your sector, give it a beat. And in that environment, I have to believe that the Fed is going to look around and say, okay, our job's not done, higher for longer, et cetera, but it's going to be more bark than bite from this point forward.
I mean, that's not necessarily, Jason, what Wall Street sees. Goldman sees 3 more hikes coming, 3 additional 25 basis point rate hikes, February, March, and May. Deutsche Bank, 17 hawks, 2 turtle doves, and a 5.1 terminal rate is the headline for them. They've got a forecast of 5.1, I mean, by May. So they see many more hikes as well. Right. I mean, the Fed chair, Jason, keeps telling you what's coming. Some don't believe it, but he's living up to the hype thus far.
There's no doubt about it, Scott. And obviously, the Fed has already moved 425 basis points this year, right? The terminal rate, to your point, is above 5% now. What I heard from the commentary in the presser the other day is he's obviously focused on labor. The labor participation rate has not moved at all. There is a structural issue with labor on the supply side, and that will continue to press and move wage inflation, right, which could be a precursor to more inflation. So clearly they're still focused on raising and hiking into the new year, but they've done a lot already. And to Josh's point, you see it, it's working. With the retail numbers we saw this morning, manufacturing negative, Philly Fed was a miss. So the work they're doing is missing, and there's a lag effect in labor. So let's see what happens going into next year. But to Josh's point as well, I think they have to continue to bark and talk the way that they're talking, but they might shift gears, going into Q2 and to Q3 of next year.